Hi, I'm Larry Berman, and I'm very excited to announce in the final episode of this year's Investor's Guide to Thriving, I have the wonderful Cathie Wood, and we're going to dig deep down inside of ARC ETFs and the innovation and disruptive technologies that she brings to investors. I'm so excited. Make sure you tune in. Hi everyone, Larry Berman here. You'll probably notice I'm standing because I'm still having trouble sitting. It's about a little over a week post-surgery now. And so thank those of you who have sent well wishes. I appreciate that very much. Surgery generally went very well. Slight complications, kind of why we had to cancel the BNN show this week. And it's been a pain in the ass. So, speak for trying to get some work done the last few days, but good. Thank God for standing desks and things like that. I may pause and sit down for a period for the whole 90 minutes, and then get back up again. Anyways, we'll see how it all goes. So this week's topic is really going to be focused on a drill down on technology in particular in the NASDAQ. We've been marketing, starting to market, and you would have seen last week BMO's introduction into the marketplace with a relationship with Cathie Wood of ARC. I had the very good luck to be able to sit down with her for an hour. So that's going to be the final presentation next week, which we're very excited about. But this week we're going to take a look at what the old technology is about, right? The NASDAQ. So we've got a great guest from BMO here with us today. I'll introduce him in a minute, and then we'll get into it. And what I plan to do today is specifically focus on technology and NASDAQ and drill down on a lot of the NASDAQ names and some of the moves, and then comment on the post-Powell response in the markets, which certainly caught me by surprise, but clearly caught the entire street by surprise, given the magnitude of the move we saw. So moving into it, as always, thanks to our partner companies for helping us with these events and sponsoring them. It's really an effort here that, without the sponsorship of our partners would make things like this, really, really not doable. Many people will know that I don't work for BNN, and BNN doesn't support or sponsor these webinars, even though we talk about them through BNN and offer them out to the BNN crowd and to everybody, frankly. But they do come to you by way of sponsorship. The production, everything that goes around in the background that people don't see, actually cost a few shekels. So it's nice to have the support from our partner companies, and in particular support from BMO Exchange Traded Funds, who have for almost the better part of a decade now been our partners in helping to educate Canadians. And for those of you who do want to thank us and have thanked us already by making a donation to cancer research at Sick Kids and dementia and Alzheimer's research at the Baycrest Hospital, we greatly appreciate your support. And so far the campaign is off and running, and we hope by the end of this segment we'll be able to get up to half our goal. Our annual goal through the BNN crowd is to raise $25,000 for these two great charities, of which we match personally and corporately. So it's a great way for your donations to get that extra kicker in terms of support. And again, thanks to those who have, and for those of you I know who will thank us at the end of the seminar series in a couple weeks. And the best way to do that, of course, is not to go to these charities directly, but to click on the links that we provide in the follow-up email to this webinar, and that way we can track your donations and match them. So this week from BMO ETFs, we have Saad Rana I,
Perfect.
I knew I was going to mess that up, but you know, I'm good with numbers, and you know, the letters are not my
You got it.
not
You got it at the end there, Larry.
thing, but I did bring it around and steer it correctly. So Saad is an ETF expert at BMO, and today he's going to talk about NASDAQ investing in the modern economy. This is going to be the opening towards next week's, which is going to focus on the next generation of investing, and that is DeFi and new technology and the new series of ETFs that BMO has come out with, followed up with my interview with Kathy Woods. So hopefully you'll join us for that as well. Obviously, a quick disclaimer from the BMO world that their portion of the presentation should always be considered educational, not investment advice, where my portion of the portfolio of the presentations are not specific investment advice to you, but general education around how to make a better investment decision. And with that, I will turn it over to Saad, and I will go off camera and then be back when he's done.
Perfect. Thanks, Larry, and for having me on today, and for all the viewers for tuning in. So as Larry mentioned, in today's session, we're going to be doing a deep dive into the NASDAQ 100 index and how you can invest in it with ETFs, also how it gives you exposure to the modern economy. So in this index, you know, we're really going to give you access to those potential game changers, those category definers, and the forward thinkers in the space. I'm pretty excited to be diving into this index today and talking more about the overall exposure. So now on this slide, if we just jump straight into it, what is the NASDAQ 100? And that's a really good question. You know, so if we look at it, the NASDAQ 100 was launched in 1985. It is one of the most well-known indexes in North America, and really the methodology is quite straightforward. So it has a top 100 non-financial companies that are listed on the NASDAQ exchange. So there's no banks, also no real estate trusts or insurers as well. It is a market cap weighted index, and we will dive deeper into this and have a look at the underlying exposure as well a bit later in the session. But yeah, it's mostly an index of technology, consumer and health companies, and a little bit of sprinkling of exposure to industrials and telecoms as well. And if we look at what's powering, the modern economies of the world today, it's these new technologies and sectors that are really highly digital and technology based. And we saw this this transformation after the tech bubble, where we went from an industrial economy to a technological economy. And the biggest companies today are tech or consumer companies. Ones like on this slide, we have Amazon, all names that we're all familiar with, Microsoft, Facebook, Google, Starbucks for that matter as well. Companies that are creating products that are really essential to individuals, but also to enterprises as well. Now, if we go on to the next slide and we look at volatility, so here we'll see that, this is an interesting chart to me. If we think of the NASDAQ 100, we think of, more growth focused companies, tech companies, and those type of companies in this specific index. We have this understanding sometimes that, probably the volatility is expected to be a little bit higher in these type of indexes. But what's really interesting is if we look at it here as a comparison against the S&P 500, if you look at this chart, it hasn't added a lot of volatility relative to the S&P, especially over the long term. Now, of course, there are periods over the short term where it may be a little bit more volatile. This past year is a prime example of that. Inflation taking hold of a lot of these cash upfront businesses that you find on the NASDAQ 100. But really what this chart is showing us and what it's illustrating is that over the long term, with a longer term view, you can see the volatility has carried very similar to the S&P 500. And that is very interesting to me. Now, on the next slide, if we dig down into performance a little bit, we are showing two charts here. Now, these are relative to the S&P 500, of course. We're not trying to pick on this great benchmark, but it's the one that we're using because it's the largest one to compare against. And here you can see that over the long term, the NASDAQ has done well. The companies in this index are really ones that invest in R&D and grow over time. And the NASDAQ has really been a valuable holding for a lot of investors. It has a great place in a portfolio, but also as a great diversifier. Especially being in Canada, the market here is pretty heavy in financials and energy, so and not a lot of tech out here. So this can be a nice complement to a home bias portfolio, or anybody that has a portfolio that may be a little bit heavy in the financial space. And so we can see here that on this slide that the NASDAQ has outperformed the S&P 500 in 11 out of the 14 calendar years. And on the right, some outsized returns relative to the S&P 500 as well. And if we go to the next slide, we can talk a little bit about earnings. Perfect, thank you. And so it's been a challenging year for all areas of the market, but for sure for the NASDAQ as well. Looking at the highlights from a few months ago from some of these larger weights in the NASDAQ 100, and looking at this slide, we see that there are a couple of headlines from earnings in the second quarter that we saw the NASDAQ 100 starting to rally even before the earnings were published back then. And the index sort of bottomed for the year, in mid-June, and then staged an impressive rally for about 2 months thereafter. Largely, we think, this was all done off of the back of investors realizing that the earnings strength and the fundamental strength of these big name companies, the ones that we mentioned on the first slide, continue to be strong. And there are a couple of reasons for this to happen, and one of them is that there are very dominant in multiple areas of business. These companies, these major names like Microsoft, Apple, Amazon, Alphabet, aka Google, they have held up tremendously well, and it is because they've built these resilient business models that are very heavily weighted towards subscription-based revenue, which is annualized recurring revenue. And they've embedded themselves with so many customers, not just individuals, but also enterprises and businesses. So this is just an example of some of the strong secular long-term fundamental drivers that really underpin the biggest names in this index. And in fact, one of the companies I didn't mention earlier that's on here too is Tesla. And Tesla may not be as diversified as the other companies right now, but they've got such a huge lead within the EVs segment that again, they're more insulated. So as such, I think that the core of the index, the earnings really underline the strength that continues to exist despite maybe some slowdowns in the economy in certain sectors. And so when looking at earnings, we should also see how that is translating into valuations and how they're looking right now. So on the next slide, this is an interesting chart that was provided from the NASDAQ team. And they did a report that was published some time ago. And one of the main points was that looking at the forecast of the index. So if you had to forecast an extended period of high inflation and high rates, how is the index positioned to deal with that? And right now is a good environment to really use against that study. So one of the main points that they looked at was from an overall indebtedness level and from a debt servicing level with interest payments every quarter. Now, in this index, it's extremely competitive versus, say, the broader market as measured by the S&P, for example, anywhere from 30 to 70% less exposed in terms of the debt burden, depending on the measure that you're using. And that seems to be quite a competitive advantage. So, investors started to realize in the summer when the index bottomed that we're well below the 10, 15-year trailing averages, for a lot of these valuation ratios. The index's earnings power is way stronger than it was 10 or 15 years ago. And so these low valuations, are they relatively, justified compared to history? And, from the NASDAQ's position, it is that they aren't. So this just goes to show that any way you look at it, all these ratios tell you that recent valuations have been, if not downright average, then cheaper than average on a long trend. So even looking at the PE ratio, especially 20 years ago, at the end of 2001, this index was at a PE ratio of over 200. It didn't even peak at 40 when the market got a little bit ahead of itself post-COVID in 2020. So that could potentially be a good entry point here. And then, when speaking on performance and valuations, it is necessary to also see how that relates to interest rates. And so we'll cover that on our next slide here. And seeing as we are in a high inflation period, and as a result dealing with rising rate environment, it is important to consider how these variables are impacting the more growth focused stocks in the NASDAQ 100. The chart on this slide, it shows what happened the last time rates went up by a similar amount. So if you look at this chart, you can see the blue line. It is very, it's a very gradual stairway up from almost 0% to about 2.5%. This happened over the course of several years, peaking at the end of 2018. Now, the Fed ended up pausing right around 2.5% and then soon started cutting after. And you can see the dip in the NDX price, which is the gray line, which looks like a minor blip, almost not even noticeable, but this was 23%. So this isn't very far from the drawdown, this year to date, although the Fed is raising rates at a much faster pace. But based on experience, the Fed may keep rates high until inflation gets under control into that 2 to 3% range. Now, the question for investors is, what happens to stocks if rates get to 3%, 4%, or maybe 5%, and perhaps stay at that level for for a few years? This is where it's imperative to look at the amount of the debt these companies have on their balance sheet, how much the interest costs will go up, and what their earnings power will look like. Will these companies be able to remain competitive, with the pricing of everything rising? Will consumers continue to pay for these products versus maybe downsizing or even substituting for cheaper alternatives? Now, these are all great questions. So when we look at the price setting ability of many of the NASDAQ 100 companies for these products and services, the ones you simply, cannot live without these days, it looks to be quite an optimistic viewpoint. Even if rates were to go up higher and stay there for a few years. So it is also important to see what kind of work these companies are doing for research and development. We have looked at, what the health is, what the indebtedness level is, but you have to look at what they're looking to continue to do to grow, but also ensure that they're staying relevant into the future. So it's important to really look at the research and development for innovation and economic growth. And so if we can go to the next slide, we can cover a bit of that as well. So this is a very important slide. We're comparing basically the S&P 500 to the NASDAQ and the level of R&D investment that the underlying companies in these two companies are investing in. So research and development is what we look at as a key driver for innovation and economic growth. Without these, we're not getting new products and we're not really getting any innovation. So what this is showing again on the slide is that the companies in the NASDAQ 100 spend nearly twice as much on R&D as the S&P 500. And it is also important to note that 77 of the 100 companies of the NASDAQ 100 are part of the S&P 500 as well. So what the chart shows is that how much of the companies in the NASDAQ spend on R&D, and how much did the companies in the S&P 500 spend. And then in the last column, in how much did the companies that are in the S&P 500 but not in the NASDAQ spend. So a lot of the growth-based companies in the US are sort of in these new economy sectors, and these are spending quite a lot of money on R&D. As if you think about it, tech, healthcare, in the consumer spaces, this is really important for growth. This helps them come up with new products, helps them with their top and bottom lines as well. And so, these are quite relevant and important for longevity and growth of these companies and for the investors looking to invest in this index. And so, this is a good segue to our next slide, where we will go through the underlying themes of the index and what it'll give exposure to. So this is an interesting slide. It shows all the exposures that you get within the diversified index. Because it can be a little bit daunting for investors who are newer to ETFs to look through that long menu and figure out what they would need. There's so many out there in the universe. A lot of what we're seeing on this slide relates back to thematic indexes and that the NASDAQ calculates in-house. This gives you a very targeted exposure to single themes that have ETFs tracking them, and they're investable as well. So you also, at the same time, when you look at what's in the NASDAQ 100, you look at the number of companies in the index, that appear in all these other single theme areas, you look at the index weights, we see, that there is a good level of diversification as well. So it's not just concentrated in just one segment, one area. We can also look at this index as a super thematic index, where just investing in the NASDAQ 100, you get a package deal, you get exposure to quite a lot of diversification and meaningful exposure to many themes, sort of right off the bat. So it's a good place to be based on the exposure and the types of companies that are in there. Now, there are, as I said, a variety of ETFs and Canadian listed ETFs one could use to gain exposure to the NASDAQ 100. Here at BMO ETFs, we offer two such ETFs. The first one is ZNQ, which is BMO's NASDAQ 100 Equity Index ETF. And this has basically been designed to replicate, to the extent possible, the performance of the NASDAQ listed companies index, net of expenses. The fund invests in and holds constituents of securities of the index in the same proportions as they would be reflected in the index itself. Now, we also have a second ETF, that's ZQQ, that's BMO's NASDAQ 100 Equity Hedged to Canadian Index ETF. So it's basically the same strategy as ZNQ, the first one that I mentioned, with the addition of a US dollar currency exposure that is hedged back to the Canadian dollar as well. So two really good ways of getting exposure to the NASDAQ 100 and really taking part in this well-timed moment in the markets. Now, if we move to the next slide, before we conclude this portion of the session, I did want to invite you to visit our YouTube channel, ETF Market Insights. This ETF Market Insights focuses on you, the investor. It is a great source to better educate you on current investment topics, themes, ETF investing for the future. Our Market Insight ETFs episodes run weekly on Fridays at 1 p.m. and this is live on YouTube. So when you do join us, remember to please subscribe and ring the bell so you're notified directly on any future shows as they get posted. And with that, Larry, I would like to hand it back to you.
Great, terrific presentation, terrific dive. I want to take you back one slide and just have a look at some of these exposures, because when you think about the NASDAQ, you think about technology, right? And why is Pepsi, for example? Now you're not the person who created the index, I get that. But when you look at what's in here, you get some consumer stocks outside the tech. And anyways, I'm going to take a look at that in my presentation, so don't worry about it. Perfect. I just wanted to highlight it because it's not a pure tech play, where next week we're going to focus with Kathy Wood on what really is new tech and pure tech, as opposed to, and all kinds of tech, bio, and computer related. So exactly, it'll be really interesting. Anyways, thanks so much for getting us going tonight with the focus on the NASDAQ 100.
Awesome. Thanks a lot for having me, Larry. Take care, everyone.
Okay. So looking here, our YouTube channel, again, it's going to be the basis of the way we distribute and communicate with all our educational efforts, on a go forward basis. So keep that in mind. Make sure you follow the channel, subscribe, ring the bell, whatever it is you do on YouTube to do that. I follow, who do I follow on YouTube? I follow the Stevie Nicks channel. I follow EVs. I'm really big on listening and watching a lot of web content on EVs and new technologies, and there's a handful of them that I follow. I'm not sure if you can follow other people on these and see what they follow, but anyways, just thought I'd mention that. A huge Stevie Nicks fan. I actually met her once. Long story, but I was speaking at a conference in Saskatchewan actually, and Fleetwood Mac was on a tour, and the tour bus was outside the hotel. And I don't know why I'm telling this story, but anyways, after a long day, I go up to the hotel and the pool and in the hot tub, and guess who's coming out of the hot tub as I'm going in? Anyways, long story, TMI, I get it. So again, the Investor's Guide to Thriving next week, Kathy Wood, and this week a deeper dive into the NASDAQ. So let me talk a little bit about what happened and my interpretation of the post-Powell surge. I don't know what else to call it. Maybe it's a little bit related to month end, but there was an expectation, including from myself, that he would try to tamp down on what they're calling financial conditions, right? So what are financial conditions? Financial conditions are what Powell talked about in his conversation with the gentleman from Brookings. And that are credit spreads, their liquidity in financial markets, their asset prices and valuations. So the S&P 500 is a big component of financial conditions. The spread between investment grade debt and high yield and what's happening in public bond markets is a big part of financial conditions and so forth. And he talked about real interest rates. So if inflation is above the nominal rate, you have negative real rates. And so, you for conditions to be very tight, you need a lot of things to happen. And so they've tightened conditions significantly, largely through weakness in asset markets and credit spreads widening, making the cost of capital more expensive to businesses. And in theory, all those things should help slow down the economy. And Powell's message, that continued to be message today, was the higher for longer, and that we want to get to the terminal rate as fast as we can. The pace needs to start to moderate as we get closer to that. So 5% is what the market thinks. We're at 4 now. 50 basis points followed by 25, followed by another 25 is probably what we end up seeing before they actually pause. So there's going to be a lot of narrative and commentary in the next couple of days around, is this the pivot? Did he was overtly dovish today. And I was really shocked by that, given how he's been overtly focusing on pounding asset prices. So what that might mean is that the Fed is starting to recognize that they've already done too much. And it's very hard for them to stop. But I think what 2023 will be is them at 5% and kind of staying there until they're confident inflation. And so that was part of his talk, was that we look at these things in inflation, and he dissected inflation down to consumer goods, inflation, core, basically services that include rents and homeowner equivalents. And that's a big part of inflation. And then finally, basically everything else that's services, which is at the essence wages, because that is the biggest component of cost that aren't materials, that raw materials. So you got the commodity component, that stabilized and come down. Question is, if the world reopens and China reopens, do we see crude oil prices shoot up to 120 next year? There's a very real risk of that if you listen to the people who are focused in the commodity space and energy in particular, that we have these really tight markets. So to the extent that they need to create a recession to make sure that that doesn't happen, the balancing act is pretty significant. Now, he expressed a lot of confidence in their ability to create a soft landing. I don't believe it for a minute. I think we are in for a recession, and the question is how deep and how long. that it's going to need to last for them to crush inflation, because he was also very clear that history has shown if they start easing too much too quickly, that inflation runs the risk of jumping again. You saw the Congress this week move on the pushing forward the agreement with the rail workers. You know, there's a lot of wage considerations, which he also talked about, that go into core inflation. And if inflation persists, right, and one of the examples he used that, you know, when you have, you know, this year, inflation is running at 7 or 8, and the employee gets a 5% raise, and they say, hey, I'm worse off, like what gives? Well, as long as inflation is going to come back down next year, and they get 5% next year and inflation's at 3, they feel good about it, right? But if inflation's still at 5 or 6, I don't expect it to be in the headline, but if it is, then they want 7 or 8 the next time around, or they're not happy, right? And you get that. And if inflation persists for a long period of time, that, like the 70s, the unions get stronger, that wage demand gets up, and that is a self-fulfilling prophecy, keeping inflation core, you know, higher. So Lael Brainerd and Powell applauded the commentary recently, you know, put out there, and the Fed highlighted that they're probably going to take their 2% target, maybe 2.5 to 3, at some point later this year, and probably around Jackson Hole, because that's when they tend to do those kind of things. So late August. And that means that the way they're thinking about things, core inflation needs to come back down below 3, probably stay there for a couple of quarters before they think about easing again. And so that puts an ease, to me, into 2024, and the curve's still pricing easing in next year. So there's still a mispricing, according to my lens. I could be very wrong on this, but the market was expecting a hawkish Powell to pound on financial conditions. And it was almost like the message was, we may have overdone it already. Now, if we get another lift up to markets here, you know, that's not going to help the case for inflation to come down if consumers are buoyed and we don't see the job losses. And so they do need to break it. They do need to break the economy to see inflation come down. And my good friend David Rosenberg is going to tell you, no, it's coming down no matter what. And, you know, I would be the last guy to debate, you know, core economic theories with him, because his level of and depth of knowledge is not where mine is. But I would debate, you know, market outcomes. And I suspect we're still going to see a lower low in 2023. How much lower is hard to say. A retest of 3,500, I would think is a very high probability as earnings get taken down and the layoffs come and Main Street starts getting hurt. That's coming. To the extent that the Fed is going to go to 6 or 7 and break things, no, we're probably not going to see that, because it's already starting to have an impact. And as he highlighted several times, the lagged impact has yet to be felt. So they got to slow things down. They got to wait to see how that lagged impact over the first half of next year, at least, goes before they would even consider communicating an ease. And I think it's well into 2024 before that happens. So for asset markets to rip higher here, listen, there's always a trade to happen. How high does it go? I don't know. It could go back up to the August peaks. I doubt it very much, but it could. We broke above the 200-day average. Is it a real trend break where we don't look back? Or is it a couple of days of Santa Claus rally expectations and then a fade? Ultimately, I don't think it's sustainable right now. Sometime down the road, late next year, after a retest of the lows, sure. You know, my pro eyes indicators are neutral-ish right now, suggesting opportunities in both directions. But we were very aggressive on the buy side when things were extremely oversold at the lows, and now, you know, really cautious. So technically, the break of the 200-day, we can actually look at it on a chart. So I can pull this up. So let's bring up an S&P 500 chart here. And let's do a simple relative strength index at the bottom and a candlestick at the top. And you could see today's, if you haven't figured it out yet, I've pre-recorded this on November 30th because I had a commitment tomorrow night that I actually couldn't get out of. So if you look at it and you say, well, we could get back up to that August high. You know, would I debate you on that? No, I really wouldn't. What I was showing weeks ago and what I felt pretty strong is that we wouldn't see this happen. But that was under the expectation that Mr. Powell wouldn't do what he did today. So when you look at the next levels, you can see that the 618 Fibonacci is all the way back at those August highs. I would give that 10%, maybe 20% of getting that high. When we talk about price gaps getting filled, there's a price gap in here. You can see it just above 4,200. And then there's a gap here that you can see it that we're in now. Maybe that's it. Maybe we test that high. Maybe we get to the 50% retracement. Like all those things are possible. Are they probable? Well, Powell said something very interesting today, and I listened acutely for the whole talk just to try to pick up on certain words that maybe he's, you know, purposefully putting out there. You know, and one of the things he said when asked about the soft landing was, well, when you look back historically, you know, it's possible, but it isn't likely. A recession's coming and a hard landing is coming. And what movements up to those levels, higher levels, tell me is that soft landing. So while not impossible, unlikely. And so I stick with my call here that maybe there's a bit more, maybe we squeeze some shorts in, absolutely possible. I'm as defensive as I can be in my strategies right now. And I've been building that up, you know, in here. A little bit at 3,900, but mostly in here in the last few weeks. And I'm just waiting for things to play out. So that's kind of my Powell talk today. You know, and let's get in and look a little bit at the NASDAQ. So this is the Qs. Let me actually one thing. The best, I may have showed this before, but the best trade I've ever made in terms of market timing was trading the Qs. But let me take you back to let's go back to 2000. Let's go back to 1999, and let's look at it all the way through 2006. So here we are, October 2002. And frankly, I don't remember the catalyst, but it was around a retest of the lows for the S&P 500. And it was literally on this day when we moved above the previous lows here that I went out with the bottom is in call. And I went out for my own personal account and I bought the QQQ. Back then it was 4 Qs when we were trading them. And so if you look at that, adjusting for splits over the years and everything else, I was probably in at 2064. And if we zoom out here again, 2004, 2005, 2006. So we got up to this period here, and I was really starting to get nervous. The yield curve just started to invert right in here. And this last move up here was my kind of out. And you could see around $45. So I took it from 20 bucks to about 45 equivalent. If we price this in Canadian dollars, so 40, 20, let's even numbers, 20 to 45. We price this in Canadian dollars. Did that work? Let's see if that worked. It did. So we priced this in Canadian dollars. We go back to this day. You can see I would have bought it at the equivalent of around, call it $33, 32 and change. And if you look at where it was ultimately up here, it's a little over 50. Okay, so I got the market call right, but what happened between the currency in that period, I'm now going to put the Canadian dollar in there. And so if we look at the Canadian dollar in October here, where we bought it, Canadian dollar was at 160. And when we ultimately sold it, in here, it was at 113. Right? And if you want to look at it the other way around, most people are used to looking at it in the other perspective. See that, turn that around for you. So if we look at it from the other perspective, here we are in October. We're at 63 cents, 62.50, and ultimately sold it at 87 cents. Whatever one of those makes sense to you. That was the difference between buying a ZQQ and a ZNQ. The currency impact of foreign investing can be massive. And we get lots of questions on, do you hedge or do you not hedge? Back then, I didn't have an opportunity to do that. There were no Canadian ETFs that gave me exposure to the NASDAQ. So if I wanted the NASDAQ, I had to do it in US dollars. And that's one of the great innovations embedded into ETFs is the ability to currency hedge and not. And I really love them for that principle themselves. So let's look at the big movers on the day, and we could see that if you were looking at the earnings, CrowdStrike. So this is a cybersecurity name. Zscaler is another cybersecurity name. Palo Alto, another cybersecurity name. So CrowdStrike had bad earnings, and the stock got clobbered, and the other names in the NASDAQ that also play in that space were weaker, though not like CrowdStrike. earlier in the day before Powell, they were down, a lot more. So that's something to note. But if you look at what worked, so here's the interesting thing. So one of the views that that we didn't see from BMO was the exposures. Baidu, the second biggest gainer in the index, is Chinese tech, right? So you're not buying US tech necessarily, right? How many people knew that when you buy the NASDAQ, you get 1.5% exposure to utilities, right? So when we take this and we look at, so this portfolio function on the Bloomberg terminal allows us to look at the characteristics of an index. So what it's doing is it's taking them, and then, so we could look at the pure technology exposure in the NASDAQ. And you could see out of the 50.1% that's called pure info tech, that Apple, Microsoft, and NVIDIA make up half of that. So it's not as a diversified index, as you think you're getting when you buy the Qs. And I love the Qs, and they're a great vehicle. But I'm going to show you an equal weight NASDAQ shortly and kind of compare that, because that puts the 100 stocks all at 1% each, which it takes these monsters, the FANG names, and normalizes them. So when you're buying technology, are you getting, that exposure? Is all technology working, or is it just a handful of stocks? So the information technology group, of course, very concentrated. Communications, telecom, so what's that? Well, that's Google and Facebook, or Meta. And again, when you look at that group at 15%, and you take Meta and Google, you can see that you got about 9% of the 15 in just in those two stocks. But then again, look at that. You've got 4 utilities. So American Electric Power, that they go around putting up cell towers. So technically, it's technology, but it isn't. It is a utility, and they get their earnings not on technology. They get their earnings based on selling bandwidth exposures. And then you've got a few other pure kind of energy companies there. When you look at it, you look at consumer staples and you say, this is a technology index. Why is Pepsi in there? Why is Costco in there? Well, why is Kraft Heinz in there? Why is Mondelez in there? Well, they were the same company, I think, at one point. Dr. Pepper, Monster Beverages, Walgreens. Why? That would be the equivalent of putting Shoppers Drug Mart, if it was an independent company in Canada, into a technology index. So, your Qs are the old way. Again, I love them, but they're not new technology, and they're really, really, really concentrated. And so you got understanding what you're investing in and what you own. Now, make no mistake about it. When you look at the S&P 500, so when you look at the SPY and the 500 names, and we use that same portfolio function, the overlap between the NASDAQ and the correlation between the NASDAQ and the S&P 500 is huge. 75 or 80% of the NASDAQ is in the S&P 500, which makes up about 30 odd percent of the S&P 500. Information technology, roughly 26%. And then let me sort this by weighting. So you can see Apple that was 12% plus of the NASDAQ is half of that, and Microsoft and so forth. So, still the big few names, but what you don't have there, you didn't have Visa, you didn't have MasterCard, and so forth. And so you can see the weights of those relative to the big names. And so you are really trading those handful of names, and you get exposure to a lot of other things. But it's not a great diversified, technology play. When you look at, if you do equal weight technology, you get RYT. Okay. So if you look at this index and you just do a little analysis here, so equal weight S&P 500, it's got a higher MER than the NASDAQ. Okay. So, but don't think about those. What are you actually owning? And so again, you're not getting, those same kind of names in here. And of course, these are all generally equal weighted. So when you look at your exposures, you don't have Apple and Microsoft, dominating the index. You've got 77 companies. So it's kind of like the S&P 500, but this is an equal weight way to play it. And so each company is more equivalent. And so, here then becomes a good comparison. So if we take a graph ratio, that's a return. And this is price only, and we compare the two. What you see over the last year is that the RYT, equal weight S&P, is actually outperforming. Let me normalize this so that these things are in percentage terms. So they both start at 100. The Qs go down more. And so the equal weight technology exposure outperformed by about 13%, with the recent high being around an outperformance of around 14%. So these, when you're playing technology, again, love the NASDAQ, but there's so many different ways to get different exposures. And I get questions all the time. My kids are young, what should I buy for them? Like, you got to know that in the long run, technology is just going to be, it's really the place to be. And Canada has almost none of it. And Shopify it's just, they still don't make any money. So it's a bad way, to get exposure, to technology in Canada, right? Now, Shopify had the up and down, and anyways, something to really think about. But there is also an equal weight Qs. So you have QQQE, okay? So equal weight NASDAQ. And we do the same analysis on equal weight NASDAQ. And so what you see here is that the equal weight technology still outperformed, but really only by 6%. So it's the mega weight, but it's not that the really good companies did really well. It was much more that a lot of really big companies in the Qs did really, really bad this year. So what we're looking at is a big company called Meta, year to date down 65%. And so, when we look at the index this way, and we look at it on a year to date, you could see that, the utility end phase, which is, apply as solar panels effectively. Pinduoduo, year to date. So the Chinese retailer, PDD, year to date up 40.72%. Now, today was a big part of that. So not all the Chinese names have had really bad years, but that was certainly one of them. Kraft Heinz here. Anyways, you can see the gainers, but let's really look at the losers here. So Apple down 16.64%. So a stock that's 12% of the index down 16, you know, that weighs a lot on the index. And so you look at some of the big names, Amazon, Nvidia, okay, big weights, Tesla. So these, if you looked at the weightings of the index at the beginning of the year, so let's go back to our portfolio here and the Qs, and these are the weights of the sectors, you know, as of today, the end of the day. But what I can do here is I can go back and say, well, what was it at the start of the year? Now, this will take a second or two to come up here, but you can see that technology still about the same, you know, not a big difference, but communications down big, consumer down big. Those are the two buckets where Amazon's in, Tesla's in, Meta. So Meta was 4.76% of the NASDAQ, and Google together was 7. You know, Amazon was 675 and Tesla was 424. So if you really look at the underperformance, let's go back to today. You're going to remember some of those numbers, but you really look at it. So consumer discretionary, and then you look at Amazon today. So it's 1.4, 1.5% of the loss in the NASDAQ was just Amazon getting smaller. And Tesla, that was 4.7, I think it was. It's now 3.19. So another part of that underperformance was Tesla, you know, getting smaller. And then if you look at here, you know, Meta, you know, got cut in half. So that was over 2%. So those three names, you know, Meta, Amazon, and Tesla combined accounted for all the underperformance of the Qs, you know, relative to, and if you looked at the S&P 500, the magnification isn't as big because they're not as big as weight, but it's there too, right? And so, you know, a very important thing when you look at indexes and you're playing ETFs that represent indexes, that you really get, you know, a good understanding about all the moving parts and kind of how they all fit together. And so, you know, that was a bit of my a deep dive on the NASDAQ and sort of bringing awareness, maybe looking at some other options. You know, there's an ETF, QQ, is it QQJ? So QQ, is it QQQJ? Yeah. So this is the next generation, they call next generation of the NASDAQ. But this is like the next 100, right? And if you look at the names in here and the weightings that you get here, Let me see if I don't think I scooped that up. Yes, I did. Okay. So let's look at the portfolio here. This is the one part I didn't highlight that I wanted to. So if you look at here, what you get, again, you got much more healthcare. So it's even less exposure to pure tech, although in healthcare, what you're getting in here is a lot more biotech, okay, than you actually have in the NASDAQ itself, and so forth. But again, you get some utilities, you actually get some material stocks in here, Steel Dynamics, that's interesting. Again, some energy names, Diamondback Energy. So the next 100 of the NASDAQ, and that's the exposure you get. And again, you can do some similar relationships and so forth. None of these names are in Cathie Wood's ARC type ETFs because, again, we'll spend a lot more time on it. But when you look at the ARC-K flagship, the only one, maybe there's a couple of, the only one that stands out to me, well, NVIDIA's there, but you've got Tesla. Where's Tesla? Where is Tesla? There it is. Anyways, you can see that those are just the movers today. But when you look at the weightings, Zoom Video, Tesla, Roku. Cathie's philosophy is to concentrate in the names that she really loves. She obviously loves Shopify a lot. So, those of you asking about a bottom in Shopify, Cathie loves it. Again, company makes no money. I don't like it here at all. Buying it on dip, sure. Anyways, okay, let's get into some of the Q&A tonight. I hope your surgery went well and you were well into recovery. I have a question. I'm having a bit of trouble trying to understand option trading and would like training to help me along. Can I suggest something? So there's a guy named Larry McMillan. Let me see if I can bring up my Google here and just do a quick search for you and show you some of his books. So you can see a couple of them here on Amazon. But he's got several books there going back years and years and years. I got first licensed in options 19, what year was it? About 30 years ago. So I've been trading options for a long time. I met Larry, came up to speak at a conference in Canada, and I got into his stuff. So there's a lot of people teaching and training, and I think a very, very trustworthy authority. Obviously, he's got products to sell and books, and he manages money and so forth. He's got a mentoring program. Again, I found him to be very trustworthy, and if you're asking for a recommendation, this is the starting point that I would push you in that direction. I don't know anyone else that I would trust that I've vetted that would fit. So hopefully you get some interesting help with that. Bank of Canada has raised interest rates 350 basis points this year to tame inflation. Will this pace slow in 23? What would cause these increases to stay on the same pace? So we got some GDP numbers this week in Canada, very, very soft. You know, in the US year to date, there's no growth. So, you know, we are seeing that the rapid increase in interest rates is already starting to take hold. So the pace is going to slow. I would think if the Fed has 100 left to do, the Bank of Canada probably has 50 left to do. So we'll see in December how that plays out, but I would expect 50 more, maybe like a couple 25s by the Bank of Canada over the next few meetings, and that's probably it. Now, depends what happens to the Canadian dollar, that they may adjust that to be more in line with the Fed, but typically, you know, they try to keep the Canadian bank rate, you know, tight to the US if they're worried about currency movements one way or the other. And I think they're pretty happy with the Canadian dollar between 75 and 85 cents in general. And as long as it's in that range, they probably wouldn't move monetary policy too much in either direction on the basis of too weak currency or too strong currency. We would have to be below 70 cents or above 85 or 90 for the Bank of Canada to use interest rates differentials as a tool to control the Canadian dollar. And I think as long as we're somewhere, the Canadian economy is well set from an exchange rate perspective in that range, and everyone's used to dealing in that for a number of years now, and we're probably good there. If we drift outside, that's where some stress comes to either importers or exporters, and we'd look to neutralize. From the perspective of the overall economy and tighter financial conditions, I don't think we need to do a whole lot more here. I think inflation is going to come down a bit, but what I'm worried about is this core wage pressure persisting for a number of years where they're not going to be able to cut rates and they're going to have to keep them here, and that keeps the economies sluggish from a growth perspective. And I think that might be, you know, the next couple of chapters in front of us. We'll see, you know, TBD, and we'll update you Mondays on BNN and when we do webinars like this and in the weekly YouTube channel and so forth with our ongoing, you know, what we're focusing on. So what's the outlook on the Canadian cannabis industry? Are we still expecting many companies and very saturated? So, you know, I was watching something on BNN the other day, and I'm not an expert in this space at all, but the play here is the legalization of, from a banking perspective, to get the US economy open. There's been all this supply come in, legal supply, because of all the changes in the laws, specifically here in Canada. They were expecting to sell flower, I guess that's what they call when the plant is ready for rolling, smoking, whatever. That was gonna generate about $10 a gram, and I believe flowers is like in the $3 range, I think this person was saying, and that there would be a need to be a lot of restructuring. We saw some news today about layoffs and restructuring at Canopy. You know, so you know, that's all coming. Let's looking at weed here. So, you know, you look at it, it's up 20 cents today. You know, relative to the market movement, relative to where it was, like I think there's a long-term base developing here that ultimately I think we get a breakout. You know, where did we go when we were thinking that, you know, a sweep in the White House was going to generate this panacea? Well, you saw base build, you saw this run up. There was a lot of memes, speculative, day trading, all of that nonsense that we said, like, fade that. Now I started buying back into this base, right? This base here where I thought was long-term, you know, support, and really it's crashed through the bottom. So, you know, you get a bit of tax loss selling coming. I think you can accumulate into that. What the outlook for the sector is, I don't know, but inevitably we're going to get banking legislation in the U.S. and, you know, it'll open and supply and demand will be better and revenues will rise, and the bottom is forming here, right, on these. How long it takes, I just don't know. The guys that I've trusted on this have been wrong about the policy ability, but there is bipartisan support for banking reform to legalize marijuana. Does it get done in the next 2 years? Does it get done before Congress flips? Does it get tucked into a bill? There's talk about that, but I just don't have a fist-pounding view on it. But the base is clear. The bottom is developing. I've been writing puts on these names. I'm accumulating. But for me, you know, if this is a growth sector that, you know, maybe we get another run to $20 or $30 over the next few years, whatever, 5 years maybe, like, that's compelling here from a total return perspective. So I think it's worth playing. But how long it takes to play out, you know, I don't have a lot of clarity on. What can we expect to learn on your interview with Cathie Wood? What topics did you cover? Well, we went through all our funds, the different mandates. We talked about genomics. We talked about a few individual companies. And so I did the interview with her already, and it's going to be edited up, if you will, in terms of production. It's not a live interview with her. But it's really, really good. And there's a lot of things we disagreed on. Crypto is one of them. But then she asked me about DeFi, and do you believe in DeFi? And I said, I do. I you know, philosophically, I'm a libertarian, and I think government's footprint on us should be, you know, about that big. But that doesn't mean I like crypto, right? I think what's happened in the industry recently tells us we need, when it comes to finance and people's savings, if you want to call investing in crypto savings, but we need regulation, and that involves government. And so decentralized financing and cutting costs out of transaction processing and everything related to that, I love the innovation. I love the disruption. She's got some great companies she owns involved in those spaces. But when it came to crypto and Coinbase and some of her holdings there, you know, I questioned her on it. And, you know, the outcome, well, tune in next week to see. But we didn't get into fisticuffs. I've used ARK and her ETFs as a poster child for the bubble that we saw during the meme phase and the bursting of that bubble and what we're seeing now. And I'm starting to build a little position where I can in some of those areas, because I think there's a lot of great companies, and we talked about CRISPR and a few other ones, Invitae. So a lot of good things covered, and I think you'll enjoy the final presentation, and I'm looking forward to actually taking a couple of weeks off, you know, and recovering from the back surgery and kind of rebuilding the back and a little bit of downtime. For me, that's going to be a little bit into January and February, and then we'll kind of see where we go from there. Can I discuss the bad debt provisions at RBC and National Bank? It appears their share prices have dropped. Can I explain what bad debt provision means and what happens in this case? So, banks lend money. And when you lend money, sometimes you may not get paid back. And there are accounting rules that say if you see some visibility on an impairment, meaning you're supposed to get paid every month on that mortgage or that loan, and all of a sudden they don't pay, they've lost their job, they left the country, like whatever the reason is, the loan becomes impaired. And after a month, you get a call from your banker, your personal person who you did the loan with, like, what's going on? Sorry, I lost my job, or I had to pay the rent this month, I needed to pay the utility bill, I'll catch up, whatever that conversation looks like. But then it could be 2 months go by, 3 months. So typically once something's about 90 days in arrears, again, there's a lot of rules around how they have to do this. They recognize that maybe we're not going to get paid back on this, and maybe that story they were telling us, whether it was a company or whether it was an individual or whatever, and they say, you know what, we may have to foreclose on that property. If it's unsecured, like a line of credit might be. If it's a credit card, it's unsecured, right? So depending on the type of loan, they'll look at all the loans they have. And at any point in time, they know if we go into a recession, which we're pretty sure we're going into, forget what the Fed's soft landing talk was. They're always going to say that because that's a thing for them to say. But the reality is we're going into a recession. And so the banks will know that the unemployment rate goes up, a certain number of people are going to lose their jobs. Based on historical trends, we have to write off some percentage. And so they take that money that otherwise would have been income, and they make a provision for bad debt. It's not real money that moves. It eats into income, and they get this provision. It's asset that sits on the balance sheet. And then when they actually have to write things off, it goes against money they've already provided for. But what typically happens, and almost always, is they provision too much. And then the actual is less than the provision, and they can release some of those loan loss provisions. And that comes back into income. So that's kind of the process. I can't speak to RBC and National Bank specifically. I'm going to look through the financials to make that specific comment. But that's the process for all banks, financial institutions, where you have a risk of a loss of capital based on a loan. So hopefully that explains a bit of that. And then next question here, Shopify. Okay, so let's bring up the charts again. Okay, so let's bring up, let's do this. And I've got my G517 screen. G is a customized screen. 517 means I've created at least 517 of these. So what this looks at is the stock, and I'm going to look at the US one here versus the Canadian one. You know what? I'll look at the Canadian one. It's fine. And so Canadian Shopify, it's the red line is what the analyst consensus target is. Again, you can see as we've gone up in recent years into the peak earlier this year, late last year. Analyst price targets, they trail, but sometimes you get to that level and they don't upgrade anymore and the stock falls off. So when you're at your analyst price target, generally, it's a bad idea to buy the stock unless you have overwhelming fundamental tailwinds that are really bullish for your name. so that you know that in the next earnings, you're going to get upgrades and earnings are going to keep growing and that kind of thing. And so, you've had green, EE, those are earnings, green, 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 green. And now 3 out of the last 4, the last 5 have been red, so they've missed. Recently they beat, and that's probably why the stocks maybe stabilized a little bit. And you look at it and you say, well, let's blow this up a little bit. So I'm going to zoom in here. And so you can see here that, stocks above the 200-day were above the analyst price target. It failed here a couple weeks ago. Like, to me, the tailwinds aren't there yet. Can this stock squeeze higher for a few more days, weeks? Sure, absolutely. That's a trade to me versus an investment. Where would I invest in this stock? Well, if this is a long-term bottom, it looks like demand for this name below 40 is really, really building, okay? If the analyst price target 12 months out is 50, where's this red line at? 54. We closed today at 55.26. Risk reward is ugly, but at 40, I've got 20% upside. So, again, if I look at how I would play this, if I wanted to, I don't own it, and I'm not doing this because I don't like the name at this point. But if I look at the option structure here and look at the puts, and let's look at March. So we'll go out a few months, we'll look at March, and we're gonna then look at the $40 range of options. And so the 40 puts for March at today's close was $1.75 bid, $2.10 offered. So you could probably, $1.85, $2.20. You could probably sell those for $1.90. So you can sell a 40 put, and then you would be obligated to buy Shopify, Canadian dollar basis, for $40 on the March expiry if we're below 40. And if not, you earn the premium. So you could earn pretty close to 5% based on $40 price point between now and the middle of March 17th, and participate in the name. Now, if it goes to the upside, you get nothing. And I'm wrong. So you got to make a call. But what you can do is you can say, okay, I'm good buying it at 40. So I'm going to do that. Let's say I'm going to get $2 for it. I'm just doing easy math here, folks. Let's look at the March calls. And let's now look at the current price area. Now we're looking at calls. So if I spent $2 in premium, on a call, what could I afford? Well, can't afford anything near the money. So what you actually have this interesting dynamic here where the out of the money calls. So this is way more out of the money on the upside. So if you think you could spend that $2 and buy a call to the upside here, but I don't see that working out here. Anyways, that's kind of my spin on that. We're running out of time, folks. Let me see if I can get to the last question here. Is there an ETF that can access alternative assets from various sectors? So the answer simply is no, but VPC is an ETF that represents a basket of private credit strategy companies. These are the public companies. These are not private markets. These are the public companies that run private market funds. In some cases, it's a public fund. It's a private, lending fund, but it's public trades. And so that's one way to do it on the private credit side. And PSP is global listed private equity companies. And then you can see what you end up buying there. But these are public companies. It's not the same type of exposure as I talk about in the private markets and private LPs and funds. So it's very different. It's the public market exposures to those companies. Those are the two ETFs that do it. Folks, we're out of time. It's been a real interesting week here with the surgery and recovering from it, and I'm getting along, and it's great. I'm hoping to be back on BNN for the rest of the year until Christmas anyways, where there's a couple holiday Mondays, and what else, and look forward to the last seminar or the last webinar next week with Kathy Wood. It's really, I think it's a really good interview with her, and you can see where we clash a little bit, but I do love what she does. I think the research their firm does is exceptional. The transparency in what they do is exceptional. Great firm, but as I always say, a great firm, a great company does not make a great stock, because it's about when you buy it for a trade versus when you buy it for an investment. Have a great week, everyone. Hi, I'm Larry Berman, and I'm very excited to announce in the final episode of this year's Investor's Guide to Thriving, I have the wonderful Kathy Wood, and we're going to dig deep down inside of ARC ETFs and the innovation and disruptive technologies that she brings to investors. I'm so excited. Make sure you tune in.